Welcome back to TalkTickers. You know, we always like to dive deep into these earnings calls, and today we're looking at Rhythm Capital's Q3 2024 report. They just had their call this morning, and well, the market seems a little unsure of what to think.
Yeah, Rhythm Capital, ticker symbol RITM, for those following along at home, is an interesting one. They're in investment management, primarily focused on real estate and alternative investments, but really they've got their hands in a lot of different areas within finance: mortgage lending and servicing, asset management, you name it.
So they're kind of all over the place.
Yeah, kind of like that friend who always has a side hustle going.
A lot of those side hustles seem to be paying off, though. They just announced their 20th consecutive quarter where their earnings available for distribution, EAD, exceeded their dividends paid. And to put it simply, EAD is that cash flow available to be returned to shareholders. That kind of consistency is pretty impressive, especially in this market.
Yeah, definitely suggests a certain stability.
Yeah.
Especially in a sector like real estate, which can be pretty cyclical. That kind of track record is, it's got to be a big draw for income-focused investors.
Absolutely. So let's dig into this quarter's performance then. We've got the earnings call transcript from earlier today and the current stock performance as per market close. What are we looking at here? What are the big numbers?
Overall, another solid quarter for them. They reported a GAAP net income of $97 million, or $0.20 per diluted share. EAD came in at $270 million, which translates to $0.54 per diluted share.
Okay.
They also delivered an 18% return on equity and closed the quarter with a book value of $12.31 per share. It's currently sitting around $12.50.
Those are some pretty healthy numbers. But the stock is only up, about 2.2% today, closing at $10.70. Seems like maybe the market was looking for a bit more. So let's talk about what drove these results. What were some of the key factors at play here?
Well, their mortgage origination and servicing subsidiary, NewRez, continues to be a real powerhouse for them. It's one of the top 3 non-bank originators and servicers in the U.S. They've got a huge servicing portfolio, over 4 million customers.
Wow.
And a significant third-party business. They got a boost from that when they acquired SLS.
Their origination volume, just looking at the numbers here, it's impressive. $41 billion in mortgages originated through Q3 2024. And that already surpasses their total for the entire year of 2023. So that's a massive jump.
Absolutely. And then you've got Genesis Capital, another acquisition that's really proving its worth. Their EBITDA has practically doubled since Rhythm brought them on board, and they're projecting to hit somewhere between $3.5 and $4 billion in originations for 2024.
That's up from $2 billion.
That's up from $2 billion previously, yeah.
That's fantastic, especially if they're keeping those delinquency rates low.
Exactly. Managing that growth responsibly is key. And then we have to talk about Sculptor, their asset management arm. They're bringing in a lot of capital, particularly in real estate and credit. Their new real estate fund, SRE Fund V, has already closed $1.3 billion.
Wow.
And it's expected to be oversubscribed.
Oversubscribed, that's a pretty clear sign that investors are confident in Sculptor's ability to generate returns. They must be doing something right?
Definitely seems to be the case. Points to a strong track record and, a solid reputation in the real estate investment world.
Okay, so it sounds like they're firing on all cylinders across multiple business lines?
Yeah.
So looking ahead, where does Rhythm see itself going? What did the CEO, Michael Nerenberg, have to say about their plans for the future?
Well, Nerenberg really emphasized a few key areas. First, they are committed to growing their assets under management, but they're not interested in just chasing size, for the sake of it. They want to make sure that growth translates into actual performance.
That makes sense. It's not just about getting bigger. It's about getting better.
Right. It's quality over quantity, which is a smart approach in this market. Another priority is expanding their direct lending activities beyond the mortgage space.
Oh, so they're looking to kind of diversify, leverage their expertise in new areas.
Mm-hmm.
I'm curious, where might they be looking? Private credit is a pretty hot space right now.
It's true, but it's also a very crowded space. And Nerenberg stressed that they're being very selective, strategic about their expansion into new areas of financial services. They want to find the right opportunities, not just jump on the latest bandwagon.
It's a disciplined approach, for sure. Probably reassuring for investors who are a little concerned about risk.
Absolutely. And the final piece of their strategy is scaling their private capital business. They're looking to rely less on their own balance sheet for growth and attract more outside investment.
So are they looking to transition more toward an asset management model, partnering with, say, institutional investors and high net worth individuals? Is that a way to amplify their returns without taking on too much additional risk.
Yeah, that seems to be the idea. Allows them to tap into a larger pool of capital, potentially generate higher fees without the same level of balance sheet exposure.
Okay, that makes sense. But there was one move that kind of raised some eyebrows. Their recent $300 million equity raise. Nerenberg did address it on the call, but can you break down why they felt this was necessary?
Sure. Well, it's important to remember that Rhythm has been incredibly effective at deploying capital without consistently resorting to equity raises. Since 2021, they've deployed $5.8 billion, mainly through their operations, their balance sheet, and some high-yield debt.
So this equity raise seems a bit out of character for them. Why now?
Well, Nierenberg explained that this move is about bolstering their position. Given the uncertain global economic outlook, the upcoming U.S. election, which could bring about some policy shifts, and their own active pursuit of M&A opportunities.
So they're building up their war chest. They want to have that financial flexibility, especially if they're eyeing some major acquisitions. It's like having that dry powder ready when the right opportunity comes along.
Yeah, exactly. It's a strategic move to make sure they have the resources to act decisively, in a potentially volatile market. It's a smart move, especially if they have some specific targets in mind. Having that cash on hand can give them a real edge in negotiations.
That raises the question, though, what kind of companies or assets might Rhythm be looking to acquire? Did they give any hints during the call?
They didn't mention specific targets, but Nierenberg did reiterate their focus on growing AUM, expanding that direct lending platform, and potentially scaling back their single-family rental business, Adore.
Right, Adore. They've got what, like 4,200 units, if I remember correctly?
Yeah.
It sounds like they might be having second thoughts about that investment.
It does seem that way. Nierenberg actually pointed out that current market conditions for single-family rentals aren't that attractive. Cap rates, which essentially measure the rate of return on the real estate investment, are sitting in the low 5% range.
Wait, hold on. Can we back up for a second? For those of us who aren't real estate moguls, can you break down what a cap rate is and why a 5% return isn't all that exciting?
Sure, think of it this way. Imagine you buy an apartment building for $1 million, and it generates $50,000 in net operating income per year. That's a 5% cap rate. The higher the cap rate, the better the return on your investment.
So a 5% cap rate in the single-family rental market, it doesn't exactly get their pulse racing.
Yeah.
What are they planning to do with Adore then?
Well, Nierenberg hinted that they might explore some strategic alternatives for Adore. He suggested it might make more sense for the business to be part of, say, a third-party vehicle, rather than remaining on their balance sheet.
So potentially offloading it to another company.
Yeah.
Or maybe even spinning it off into a separate entity.
Exactly. If they're not seeing the returns they want, it makes sense to free up that capital and deploy it elsewhere.
It's like they're pruning their portfolio, getting rid of the branches that aren't bearing enough fruit and focusing their energy on the ones that are thriving.
That's a great analogy, and it really ties into their disciplined approach to capital allocation. They're not afraid to make tough decisions, to adjust their strategy as needed.
So if we zoom out a bit, it's clear that Rhythm has a lot going on. Mortgage origination and servicing, asset management, real estate investments, and now this potential expansion into direct lending. It's a pretty diverse portfolio.
It is, and managing that kind of complexity, it can be challenging. But what stands out to me is that they seem to have a pretty consistent strategy, running through all of these different activities.
What would you say that common thread is? What's their kind of overarching goal?
At the core, it seems to be about generating sustainable returns for their shareholders, regardless of what the market's doing. And they're achieving this through operational efficiency, disciplined capital allocation, like we just talked about with Adore, and a focus on building those diversified platforms.
All while navigating a pretty uncertain macroeconomic landscape.
Yeah.
Inflation is still a concern, interest rates are rising, and there's a lot of geopolitical tension out there. It's a lot to juggle.
Absolutely. But what I found interesting on the call was Nierenberg's outlook. He acknowledged the challenges, of course, but he also highlighted those opportunities that often emerge in times of disruption.
He specifically mentioned how banks are pulling back, looking to reduce their risk, and that creates openings for, non-bank lenders and asset managers like Rhythm. It sounds like they're positioning themselves to capitalize on those shifts in the market.
They are. And don't forget, they're also actively looking for those strategic acquisitions. So they're not just playing defense, they're looking to go on offense, potentially accelerate their growth through M&A.
That recent equity raise makes a lot more sense now, considering their potential M&A ambitions. But what about the risks?
Well, the mortgage market, while showing signs of stabilizing, is still facing some headwinds, and their expansion into new areas like direct lending, will require careful execution.
They need to make sure they don't overextend themselves
Yeah.
and that they really understand those markets before diving in headfirst. It's about deploying that capital wisely, not just aggressively.
Precisely. And when it comes to evaluating Rhythm as an investment, that's the big question for investors. Is RITM a buy?
Do they pass your test?
That is the million-dollar question, isn't it? It's a tough one, especially with so many moving parts.
Yeah, it really is. There's a lot to like about Rhythm Capital. They've got that strong track record,
Yeah.
a diversified portfolio that spans, several attractive areas of finance, and a management team that seems to have a clear vision for the future.
Yeah.
But as we've discussed, they're also operating in a complex and ever-changing market.
Yeah.
So there's no guarantee that their success in the mortgage market will just, automatically translate to new areas like direct lending. And then there's those macroeconomic headwinds that are still out there.
You're right. You're hitting all the key points. Ultimately, whether or not to invest in RITM is a decision each individual investor has to make for themselves, based on their own research, risk tolerance, and investment goals.
Right. We can't give financial advice here. But what we can do is provide the information and insights that will hopefully help our listeners make a more informed decision. So let's try to kind of distill what we've learned today into a few key takeaways for our listeners.
Sounds good.
First and foremost, I think it's important to recognize that Rhythm Capital is much more than just a mortgage company. They're a diversified financial services platform with expertise across a range of asset classes. They're not a one-trick pony.
Right.
And they're not afraid to adapt. They're willing to scale back in certain areas if their returns aren't there and aggressively pursue new opportunities when they see potential. That flexibility is really important in this kind of dynamic market.
Yeah, absolutely. And it seems like they've got a management team that's not afraid to make those tough decisions, which is a good sign.
Okay, so that's one key takeaway. What's another one?
Well, their focus on generating that consistent cash flow and returning value to shareholders through dividends. That's something income-oriented investors should find appealing, especially with that 20-quarter streak of exceeding their dividend payouts with EAD.
All right, that's two. What else? What else stands out?
Well, their current stock price, based on some of the parts analysis, which essentially means valuing each of their businesses separately and adding them up, it seems like their stock is undervalued.
You mentioned this earlier,
Yeah.
but for those who might not be familiar with this type of analysis, could you maybe break that down a little bit?
Sure. It's a way for investors to estimate the intrinsic value of a company. You're looking at the individual pieces of the business, assessing their worth, then adding them all together to see if that current stock price actually reflects that total value. In Rhythm's case, it looks like the market might be discounting some of their assets or, future potential.
So that could be an opportunity for, say, long-term investors who believe in Rhythm's strategy and their ability to execute.
Yeah, potentially. But it's important to remember that every investment comes with risks. Rhythm is no exception. The mortgage market is still working through some challenges. Interest rates are a wild card. And there are always execution risks associated with expanding into new areas, like we talked about with direct lending.
All right, so our final takeaway.
Do your research. Before making any investment decisions, it's essential to really dig into Rhythm's financials, understand their strategy, and, carefully consider their risk profile relative to your own investment goals and risk tolerance.
Solid advice. That's always good advice. We've done our best here to break down Rhythm Capital's Q3 2024 earnings call. But the final decision, of course, rests with you. It's your money, and it's important to be an informed investor.
Well said. Rhythm Capital is a fascinating company with a lot of potential. But like any investment, it requires careful consideration.
Well, thank you for joining us on TalkTickers. We'll be back next week with another deep dive into an earnings call. Until then, happy investing.